In 1980, silver exploded to levels no one thought possible, then collapsed nearly 90% in months, bankrupting some of the richest investors in America. In 2011, it surged again, touched the same zone, and then fell more than 30% in less than a week, vaporizing billions in paper gains and trapping late buyers at the top. In 2021, a coordinated wave of online traders tried to force a silver squeeze, and the entire move died almost immediately. Every time the story was the same: excitement, confidence, then sudden destruction, and now it's happening again. Silver has surged beyond every previous historical peak, pushing into price territory that simply didn't exist in past cycles. This isn't just another marginal breakout. This is a level that forces markets to react. Here's where it stops being normal. Physical silver is being moved across continents at scale. Emergency shipments are being redirected between major financial hubs because vault inventories are running dangerously low. That doesn't happen in a hype-driven rally. That happens when supply is tight and delivery matters. At the same time, monetary conditions have shifted in a way that consistently fuels precious metals. Policy changes have increased demand just as online predictions are spiraling toward extreme targets. 80, 100, higher. On paper, early money has already doubled. That alone is enough to pull crowds back in. But history is clear. This is exactly what every failed silver rally looked like right before it broke. So this is the only question that matters. Are we watching another familiar cycle of speculation and collapse? Or is this the first time the market itself is under real physical strain? On paper, the gains look spectacular. Silver has doubled, outperforming stocks and leaving gold far behind. That alone is enough to pull attention back in. And it leads to the question everyone keeps asking: is this just another case of the boy who cried wolf, or is the wolf finally real? Because here's the part most people don't like to hear. I've seen this exact setup before. Not once, 3 times. And every single time it ended badly. At least until now. That's what we're here to figure out, because whether you own silver or not doesn't really matter. When commodity markets enter this kind of phase, the effects don't stay isolated. They ripple through currencies, industries, and eventually into your purchasing power. This isn't financial advice, it's education. And by the end of this, you'll know how to think about what comes next. To understand what's happening now, you have to go back to the 1970s. The economy was unraveling. Inflation was surging into double digits. Energy shortages, geopolitical shocks, confidence in paper money was breaking down. 3 brothers from Texas looked at that environment and came to a simple conclusion. Cash was a losing game. Silver was the escape. They started accumulating quietly at first, when prices were still low and reasonable. Then it escalated. What began as a hedge turned into an attempt to control the market itself. Within a few years, they controlled more than 100 million ounces, roughly a third of global supply. 3 individuals holding more silver than most governments. The price followed, from single digits to levels no one thought possible in barely a year. The profits were enormous, on paper. Then reality hit. The positions were built on leverage, borrowed money. When prices stalled and began to slip, margin calls followed. They couldn't meet them. The unwind was violent. In days, silver collapsed by more than half. Fortunes vanished almost overnight. The aftermath was brutal. Legal consequences, fines, lifetime bans, bankruptcies. Silver itself lost nearly 90% of its value in the years that followed. And the lesson was simple. You can't force a market to bend to your will. When an artificial squeeze breaks, it breaks fast. No matter how much capital is involved, when an artificial setup starts to unwind, it doesn't unwind slowly. It snaps. You might think that was a long time ago. Different era, different market. Surely the lesson was learned. It wasn't. Fast forward to the aftermath of the global financial crisis. Central banks flooded the system with liquidity. Trillions were created. Inflation fears surged. Confidence in fiat currencies weakened. And once again, silver became the story. Prices surged in a matter of months. The narrative was familiar. This time is different. Real inflation, unlimited money printing, a collapsing dollar. Then, almost overnight, it fell apart. Silver dropped sharply in days, and the damage didn't stop there. What followed was years of decline. Anyone who bought near the top waited more than a decade just to break even. The lesson was clear. Monetary policy alone doesn't sustain a rally. When price action is driven mainly by speculation instead of real demand, the reversal is brutal. Then came the shortest cycle of all. A burst of online enthusiasm after a historic short squeeze elsewhere. Social media declared silver the next target. Prices jumped briefly. Headlines screamed victory. And then it was over. The market was simply too large, too liquid, too deep to be cornered by coordinated posts and momentum trades. So the pattern repeats. Manipulation collapses. Speculation collapses. Hype collapses. Which brings us back to the present phase. Look at the sequence. The first cycle lasted years and ended in a 90% crash. The second lasted months and lost more than 2/3. The third lasted days and failed immediately. Each cycle burned faster than the last. And now we're looking at another surge. But this one didn't start with leverage. It didn't start with narratives. It started with something far harder to dismiss: a persistent supply deficit. For multiple consecutive years, global silver demand has exceeded production, not occasionally, every single year. The gap has compounded. Hundreds of millions of ounces consumed beyond what was mined. Stockpiles built over decades have been quietly drained to fill the difference. At the same time, mine supply hasn't surged to meet it. Silver isn't primarily mined on its own. Most of it comes as a byproduct of other metals. When those operations slow, silver output falls with them. You can't flip a switch and flood the market. And here's the shift that matters most. Industrial demand now makes up the majority of silver consumption. This isn't jewelry. This isn't investment speculation. This is modern infrastructure, and there isn't enough metal to meet it. Three forces are now consuming silver faster than the world can produce it. The first is solar. A massive share of global silver output is being absorbed by solar panel manufacturing alone. Hundreds of millions of ounces are embedded into panels each year. And the scale isn't slowing. Production is accelerating at a pace that's difficult to overstate. Here's the part most people miss. Once silver is built into a solar panel, it's effectively removed from circulation for decades. It isn't economically recycled at scale. That demand doesn't reset, it accumulates, year after year. The second force is electric vehicles. Each EV requires significantly more silver than a traditional car. Not for luxury, for basic electrical systems. Multiply that by tens of millions of vehicles, and you're talking about an enormous recurring draw on supply. The third is digital infrastructure, data centers, AI training clusters, 5G networks, semiconductor fabrication. Every layer of the modern digital economy relies on silver for conductivity and reliability. This demand doesn't disappear when sentiment shifts. Servers still need to be built. Networks still need to expand. This isn't investment demand. This isn't jewelry. This is infrastructure. And there's no real substitute. No other material offers the same combination of electrical performance, thermal efficiency, and cost at scale. That's why the pressure is showing up in places most investors never look. Major precious metal vaults have been pushed to critical levels. Physical metal has been moved across continents under emergency conditions to prevent delivery failures. That doesn't happen in a normal bull market. I've followed commodity cycles for years. This is different. When financial centers are forced to reroute physical supply just to keep the system functioning, that's not optimism. That's stress. Inventory levels in key hubs have been draining rapidly. The market has shifted into backwardation, where buyers pay a premium to get silver immediately rather than wait. That's a classic signal of acute scarcity. And then there's the final shift. Governments have begun designating silver as strategically important. When a commodity moves into that category, it stops being just another asset. It becomes a resource. That's the core distinction. Past rallies were driven by behavior that could reverse overnight. This phase is driven by a mathematical imbalance. Demand exceeds supply. Not temporarily, structurally. In previous cycles, smart money sold into hype. In this one, industrial users are competing for material they genuinely need. That's not narrative. That's supply and demand. Now pause for a moment. None of this means prices move in a straight line. Even real shortages don't eliminate volatility. After a move this large, sharp pullbacks are not only possible, they're likely. None of this changes the core story, but it does change the risk. After a move like this, pain is still very possible, especially for anyone who arrived late. And there are three ways this setup can still break. The first is a recession. Industrial demand makes up the majority of silver consumption. If the global economy contracts, that demand can disappear faster than supply can adjust. Large projects lose financing, solar installations slow, electric vehicle sales decline as consumers pull back, capital spending gets frozen. We've seen this movie before. During the financial crisis, silver collapsed even though long-term fundamentals were intact. Demand destruction overwhelms theory. The second risk is intervention. History is very clear here. Both major silver collapses ended with rule changes. When banks or institutions holding large positions come under stress, regulators step in. Margin requirements change. Trading rules shift. Forced liquidations follow. It's not hypothetical. It's precedent. High prices also attract supply. At elevated levels, mining suddenly looks profitable. Projects that were once uneconomical get restarted. New capacity comes online. It doesn't happen overnight, but over a few years, supply responds. No shortage lasts forever if prices stay high long enough. The third risk is you. Human psychology is always the weakest link. A sharp correction doesn't need bad news. A 20% drop is enough to shake out anyone who bought on emotion. When early buyers are sitting on large gains, the temptation to lock profits is powerful. If enough people rush for the exit at once, selling feeds on itself. There's another layer here. Monetary policy can shift. If inflation proves more persistent than expected and rates stay higher for longer, the dollar strengthens. Precious metals lose some of their appeal. The narrative changes quickly. History leaves clear rules. Don't use leverage. Excess debt destroyed previous cycles. Watch policy signals closely. Markets don't collapse on headlines. They collapse when rules change. And never confuse strong fundamentals with guaranteed outcomes. Position sizing matters. Timing matters. Diversification matters. You can be right about the long-term story and still lose money if you ignore risk. Let's go back to where we started. Is this just the boy who cried wolf, or is the wolf really here? Based on everything we've explored, the current market dynamics, historical lessons, and the fundamental analysis, here's my conclusion. This time, the fundamentals are real. The 2025 silver rally is driven by something that previous rallies weren't. A genuine multi-year structural supply deficit is meeting unprecedented industrial demand. The rallies of 1980, 2011, and 2021 were driven by temporary factors: manipulation, speculation, and social media hype. Unsustainable. This time we have a real deficit and a surge in industrial demand. This is sustainable, but it will be volatile. The wolf is real this time. The shortage is real. The industrial demand is real. The depletion of vaults is real. But, and this is key, being real doesn't mean risk-free. Just because the fundamentals support higher prices doesn't mean we won't see painful corrections along the way. Markets don't care about your cost basis. They don't care if you've been right about the fundamentals. Even if silver hits $80 or $90 by late 2026, the path to those prices will likely include a 20% correction or two that shakes out weak hands and tests your resolve. Remember, in 2008, during a fundamental bull market for gold, silver still crashed 50% before ultimately making new highs. So what makes 2025 different? In previous cycles, 1980, 2011, 2021, the smart money sold into the rally. But this time, they aren't just selling, they're dealing with a real procurement problem. Industrial companies need silver for their production lines. They can't afford to wait. That's not hype, that's mathematics. You can't manufacture 200 million ounces of silver for solar panels if there aren't 200 million ounces available. The laws of physics don't care about sentiment. Key indicators to watch: Shanghai inventory levels. If they keep dropping, that's bullish. If they rebuild, that's bearish. Solar panel production data from China. This is a leading indicator of industrial demand. Fed policy signals. These determine the broader monetary trajectory. For those thinking about positioning, long-term holders. If you believe the supply deficit story, volatility is just noise. Consider dollar cost averaging. Traders. Use tight stop losses and take profits on rallies. Don't fall in love with positions. For those on the sidelines, a pullback might offer better risk/reward, especially given the 100% rally. A correction to $48 to $52 could offer a better risk-reward entry point. I'll leave you with a quote from economist John Maynard Keynes. Markets can stay irrational longer than you can stay solvent. The wolf is real, but that doesn't mean you won't get bitten if you're not careful. You can be right about the fundamentals, but still lose money if your timing is wrong. If you're overleveraged, panic and sell at the bottom, or let a short-term shock temporarily derail your long-term thesis, then you're setting yourself up for a painful fall. The question isn't whether the supply crisis is real. It is. The real question is whether you can handle the volatility on the way up. History teaches us this. You can be right about the destination but still lose everything along the journey. The wolf is here, just don't let him eat you.